Well, Peter Morici joins me now. Peter, let's talk about sales. A lot of words. Of course, we don't know what the retail sales are going to look like, but today's actual discounts, are they real discounts, or are they just bringing prices back to the inflation-adjusted pre-pandemic levels?
Well, they're certainly not going back to pre-pandemic levels, but compared to the prices that were available last week or 2 weeks ago, they are discounts. I mean, I'm seeing it come in my email from various suppliers, retailers and so forth. They are offering better prices today than before the sale. What's going on here is the economy slowing. 4% gain in retail sales after inflation is 1%. And what are economists predicting for growth over the next 3 quarters? About 1%. So it's kind of in line. A slowdown, not a recession.
So you think it's going to be a soft landing, which means essentially, because we still have inflation, that we can call it stagflation.
Well, it's not a soft landing if you have inflation above 2%. I mean, their job is to get inflation down, get down to 2%. But I think that the White House will be heralding a soft landing, and the Trump campaign will be telling us how awful the world really is.
Yeah.
The reality is the truth is someplace in the middle, and this president is in trouble because so-so economy is not great for an economy.
Well, here's another reality. We've got a new survey out showing that 25% of Americans are still carrying debt from last year's holiday season. That debt is now going up to 25, sometimes 29% on these credit cards. That's a big problem, isn't it?
Yeah. We hear that people still have pandemic savings, and on average, they do. But there's a lot of variability in the economy. A good example is Michigan. Real incomes are down there, even though the auto workers are getting these big raises. The lady that down the street that works, the waitress at the diner is not getting this big raise. Yeah. And Biden is behind Trump in Michigan after landing that big UAW contract. It indicates that a lot of people in the economy are not doing nearly as well as the average. Real wages are down. There still is some pandemic savings around, but many people are in the hole. And that is the reason the economy is becoming the issue that it is. If it wasn't, the Middle East and all the rest.
Yeah. And even though mortgage rates have come down a little bit, they're still well over 7%. If you try to buy a car on credit, you're going to be paying a huge interest rate as well. So interest rates in general are big. And there's a macro situation here, which is that Treasury is going to be issuing $1.6 trillion of new bonds over the next couple of quarters. At the same time, the Fed is not buying as much as they used to. So in order to sell those new bonds, Treasury is going to have to lift rates, right? So there will be pressure for rates to stay up.
Well, the interest rate now on a 10-year Treasury has gone up much more than the last increase in the federal funds rate. Last April they raised it a quarter point, and the rate on a Treasury is up 0.6 of a point, even though it has come down from its summer highs. This is kind of a lean quarter for new Treasury securities. The Treasury isn't issuing as many as it did in the last quarter. But the beginning of next year, they're going to need a lot more money again.
That's right.
And I would think that we're going to have this problem. There's another problem here, too. Because the Fed moves so slowly on inflation, now we're going through a very long period of screwing down the housing market. Remember, those houses that didn't get built are now not available for sale. They're not available to rent. So housing prices are going up because we've had this slow motion response to inflation. And so, you've got the twin effect of mortgage rates are going to stay up a long time because the Treasury's borrowing and spending so much. Right. And there are too few houses around to buy.
Yeah, it's a big problem. Peter, thank you so much. Have a good weekend. Good to see you.